So in some ways it was one of the first areas to be attacked, but the institutional space is very much the last. If you think about what equity crowdfunding did, equity crowdfunding was offered consumers for the first time ever the opportunity to access a very boutique asset management space, which was unlisted equity. It gave people the opportunity to access a space that was formerly the preserve only of high net worth individuals, experienced investors, or VCs and private equity. So this unlisted equity space. And now the consumer could buy it. And you could buy it in small amounts. You didn't have to have £200,000 to invest as one of 5 investors in a startup. No, you could do it with 5,000, 1,000, or even small amounts if you go through things like Crowdcube. So I'm not saying it's not risk-free, it's very risky, and I think people don't understand the risks of equity crowdfunding, and there are lots of them from the consumer point of view, and that's what the regulator is looking at the moment. But nevertheless, it gave people access to a new asset class they'd never had access to. And peer-to-peer gave people access to sources of debt funding, i.e. if you wanted to borrow money or you wanted to lend money, you could find an intermediated market in almost anything. And the consumer got very excited about it. And it was really nice to see consumers actually excited about the process of asset management. To my mind, the consumer as a rule is particularly indifferent to asset management. And asset managers really in the UK only sell to the same small fraction of the population the same products. Millennials don't buy. Generation Y does not buy asset management products. Anything that has a 20 or 25 year or even a 5-year horizon makes no sense to them. So actually the asset management industry has not engaged with the consumer in the way in which the consumer wants to be engaged with, other than this new asset class of equity crowdfunding, which everybody gets excited about. There are so many options. You can have rewards-based crowdfunding. You can have proper private equity shareholder, VC model shares that you can have issued by Syndicate Room, Crowdcube, or any one of a number of equity crowdfunding platforms. And people get really busy and excited in this space and are enthusiastic in a way that they are totally unenthusiastic about their long-term savings. I've seen people that get excited over a weekend about 10 small investments across a peer-to-peer platform and yet will avoid the issue of doing their allocations for their pension funds. It's the biggest single asset you've got apart from your house. Why wouldn't you care about your pension fund? But people don't. So I think the asset management industry has not engaged and needs to engage, and finding the model through which they can engage is very important. Well, let me present an interesting fact for you. So I actually first heard part of this from Richard Harrington, who's the pensions minister. And what he said is the average salary in the UK is give or take £25,000. Which means that when you retire, you'll be looking to get an income of about £18,000, of which the government gives you £8,000 because that's the basic pension, which means you've got to find £10,000, right? So you've got to find £10,000 equivalent annuity value. And there are different ways of looking at it, but we'll assume it's annuity. To be able to fund yourself with £10,000 worth of income a year, you need a pot of £200,000. So you need to save across your lifetime a pot of £200,000 to generate this differential of £10,000 of income to have you on a parity lifestyle. Actually on something that's actually 30% less, because you're only going to have £18,000 and not £25,000. That £18,000 is still taxed, by the way. So you're going to get this £18,000, you need to save £200,000. But look at the numbers. If you're earning £25,000, you need to be putting aside 10% of your annual salary, 10% of your gross salary, to be able to generate anything near, under current rates of return, £200,000. So in other words, people need to save a huge portion of their disposable income to be able to generate that pot of £200,000. The problem is twofold. One, it's an impossible equation, and B, people don't even realise it's an impossible equation. So they maybe have a pension pot that's only worth £100,000, and what they don't realise is when they retire, they are not going to have any money whatsoever. So the education is twofold. One is you have a problem, most people won't acknowledge it, and B, you've got to save a whole lot more money. When you do recognise the problem, it may be too late, and even if it's not too late, you still have to save a heck of a lot of your disposable income to make that amount of money. So the uncomfortable truth is most people are going to be very, very poor when they retire. That is the uncomfortable truth. And it's simply because, A, £200,000 now under current rates only gives you £10,000. It used to be £200,000 gives you £20,000, right? Now it's £10,000. And secondly, the rates of return on your pension fund are so low that the compounding performance of you putting in money in over the lifetime of the pension fund will not generate £200,000 worth of income. It's a really, really horrible state of affairs. Acknowledging that and solving it should be the most important thing that we're working on, bar none. It's the biggest social challenge that we have. Why would you try and solve a £2 million problem when you can solve a £2 billion problem? And I figured out that the largest market of all of these, bar none, is the pension fund world. That's where the money is. We have between 1 and 2 trillion of pounds of our cash in banks. We have between 1 and 2 trillion pounds of that as mortgages. We have nigh on 7 trillion pounds in the UK in long-term savings products. So if there's going to be a way of figuring out where the money is and sorting out problems in that space, let's look at the biggest problem. Let's look at the biggest space, because that's where things will be most easy to find, and that's pension funds. Turns out it's also the most opaque. So if one tries to get information on how the pension fund market works and how much it costs, it's nigh impossible to do so. And I can tell you it's nigh impossible. I've been doing it now for 8 years to try and discover this. And there is so little information discovery, price discovery, it beggars belief. So my goal for the past 7 or 8 years, as well as developing all of this interested infrastructure in fintech, is to figure out the size of the problem. What is the problem we're trying to solve? And actually, it turns out it's a big one. So the problem is this. Why is it that our pension funds are not performing? And the answer is there are so many intermediaries between your money and the marketplace and back again that the performance of your assets is drained. You have no idea what your gross performance is. You're only given a net figure. And that's fine as a net figure in a growth market when the markets are going up. But when the markets are falling and the margins are fixed, or the costs rather are fixed, it means that you may find yourself even in a marginal growth market with a negative return. So actually, if one looks at the equations, if one looks and figures this out, most of your return is a result of the tax benefits you get from tax incentivization from the government. Most of your performance in your pension fund comes from taxation, i.e. tax relief on your investment. If the government didn't give us tax relief, your pension funds would be going nowhere right now. I promise you that. So the problem we have here is that because you don't know what your gross performance is, you can't expose exactly how much tax you're receiving, which boosts the performance of your pension fund. So what becomes interesting is how much does it cost in terms of all of those intermediaries to run a pension fund? And there is an answer. I have found pension funds, and I'll start off somewhere else. If you buy a retail fund, the AMC or the TER is the number that you see, which may be about 1%. But actually, the total cost of owning that retail fund in a listed equity space may be as high as 3 or 4%. I wrote a paper on this for the government back in 2009. In the pension fund space, it's a similar figure. There is a globally acknowledged cost of owning a pension fund. When you buy an asset manager, when you buy a pension fund, what you're really buying is the expertise of the asset management industry to make better decisions than you on where to put your money. That's really what you're buying. And there is a global cost for that. It doesn't matter which market you look at, in an aggregate fashion, you shouldn't be paying, from the cost of asset management, this is taken straight off annual reports of pension funds, you shouldn't be paying more than between 30 and 50 basis points. That's how much it should cost you. That's actual figures that are taken from annual reports. The World Bank has published this data, IOPS has published this data, I've published this data. It's between 30 and 50 basis points. That's the global price point for asset management. Then why the hell is it when you do analytics around the actual cost, the journey, all of the implicit costs that you get exposed to as a result of this 30 to 50 basis point explicit cost, do you find instances where it's as high as 5% or 500 basis points? What we're buying is 30 basis points. That's what we really want to buy, but it's costing us 5% or even 4% or even 3%. It doesn't matter. We're paying a lot more than we expect. What are we paying for in that difference? So if we're expecting to pay 50, but we're paying 3, what is the 2.5% difference in costs? What is it paying? And I'll tell you, largely it's intermediation, infrastructure, and administration. Now, those are 3 things that can be sorted out with technology. It doesn't matter where you are, any technology program will be, for for the benefit of taking away infrastructure, intermediation, and administration. That's what the technology is there for. That's people. You want to replace it with technology that cuts out that cost. So the prize we're going for is to reduce the costs of owning a long-term asset by between 2% and 5%. And why is that important? Well, because that represents £300 billion worth of prize. So if as an entrepreneur you can find a way of just doing the thing that helping an asset manager just do the thing it's good at, which is decision making and timing, then you end up with something which could save the consumer a prize of £300 billion or thereabouts a year. And that's a big number, but it's got a few significant upsides to it. One of those is if you can add back in that between 2 and 5% to the long-term savings of a pension fund, you uplift the terminal value of that pension fund by as much as a factor of 400%. So over a 47-year saving period up to the age of 65 from 18, you would end up with a pension fund that's worth 4 times what it is than if you just saved under the current scenario. So in other words, you would end up retiring on more money than you had as salary when you retired. That's one way of looking at it. Another way of looking at it is that you would be able to retire 17 years earlier because you reach the value X, which was the terminal value of the pension fund in the original scenario, at the age of 45. Fantastic, I'd like to retire at 45, but really that's not good for productivity. It's probably not good for personal health either. Work is good for you. I think that's probably a very good way of putting it. Being busy keeps you young. So 45 is not a good age to retire. So what's another way of looking at it? Another way of looking at it is you wouldn't have to start saving until you were 35. Now that's quite important because actually you would find therefore that you would save an entire generation of young people who have singularly failed to save. Now the reason why we want to do that is because when we're in our old age, it's these young people who are going to be paying for our pension funds. So we want to get them saving. But actually most young people don't think about saving until it's really the last moment, which is roughly about 35. That's when I thought about it. We're trying to reset that paradigm, or we should be trying to reset that paradigm right now to get the industry to start young people saving at a much earlier age. They're failing to do it, young people are failing to do it, but if we can just cut out all of this cost, if we can reduce the marginal cost of all of that intermediation to just a few basis points from percentage points, we get to save our kids and our kids' kids. It's a very important thing because this is the challenge that I want to lay down to entrepreneurs, right? This is the thing you should be solving because it's for the good of the community and there is a long-term benefit here.
Shortlisted Productions specialise in the production of business video content for corporate clients. Please contact us for a free quote at shortlistedproductions.com.